Gosh, you listen to these two. How are you supposed to know how an increase to the capital gains tax will affect you? Is it, as the finance minister suggests, a tax on the ultra-rich?
Only 0.13% of Canadians with an average annual income of $1.4 million will be affected by this change in any given year.
Or is it, as the opposition leader tells it, just crushing the little guy?
Mr. Speaker, if you are a small business owner, you have even $1 of investment gain, you pay this higher tax that the Prime Minister is promising.
Then, Pierre Poilievre puts out a video saying everything is broken and the country is broke.
Businesses, jobs, doctors, and food production will leave Canada.
And Justin Trudeau's like, don't believe those guys.
They're all trying to spin it in 9 different ways.
So let's just try to calm down and figure this out. We'll start real easy with what is the capital gains tax, but then we'll sort through how it's going up, who that affects, and ultimately, which politician, if any, is telling the truth. So this section won't be very long because it's actually really simple. Capital gains are just profits that you make from selling certain things. Stocks, bonds, investment properties, those are kind of the main ones, but it could also be shares in a business, crypto, precious metals on the stock market. But let's say I buy $100 worth of Apple shares. The company does well, and I'm able to sell for $200, which, if you do the math, that's a profit or a capital gain of plus $100. You with me so far, right? Now, in Canada, 50% of capital gains are taxed, like regular income. So let's say I make normally 50 grand a year. I add 50% of this, which is $50, to my income, and that's taxed at my regular income tax rate. So if I live in Ontario, that means I get taxed around 20% for making this much money. So the government takes 20%, that's $10 of what was ultimately a $100 profit. That's how things already are. What the government is going to do, effective June 25th of this year, is increase how much of my profits get taxed. So returning to this example, instead of getting taxed on just half of my capital gains, the government wants to increase this so-called inclusion rate to 2/3. So about 66% of my profits become taxable. And this is where I think a lot of misinformation has gone around, where people say that, oh, the government now wants to tax 66% of my profits. And that sounds like you're losing 66% of your money. But it's not that. It's making 66% of your money taxable, where 50% of it was already taxable. So now, $66 of my original $100 profit is taxable at my current rate of about 20%. That means $13 goes to the government. Before it was 10, now it's 13. But wait, we're not done, because the government, perhaps realizing taxes are unpopular, has also created a $250,000 individual exemption.
Starting June 25th, if someone makes up to $250,000 in capital gains, they're still going to pay taxes on only half of that.
So in any given year, as long as my capital gains are less than $250,000, I don't have to pay the new 66% inclusion rate. I only pay capital gains tax on the same 50% that I always have. Meaning, even under the new rules in this scenario, because the profit is less than $250,000, I would still pay the old amount. Okay.
We don't think it's fair that a teacher or electrician pays taxes on 100% of their income, while a multimillionaire pays taxes only on 50% of the passive income they make on capital gains.
So the government is telling the truth. right? That exemption is so big, $250,000, that surely only the ultra wealthy, the top 0.1%, cashing out hundreds of thousands of dollars in investments each year, only they would pay more. And then the government takes all that money and spends it on all kinds of nice things that we all like, right? Well, that's not really true.
I can't see how such a small percentage of the population will be affected by the new rates. To me, it has to be larger.
Really, you should look at it. How many people in their lifetime will be affected by this capital gains increase? And it's going to be a much higher number. And what I estimate, it's going to be something like 1.25 million people.
Okay, let's explore that. What the government isn't exactly coming right out and announcing is that, yes, while in any given year, very few Canadians are claiming more than $250,000 in capital gains, that's not to say that many Canadians will not claim that much at some point in their lives.
So you buy a cottage, let's say in 1980, Vancouver, the Toronto area, for let's say, $80,000. But then today you end up selling the cottage for, $500,000. And so you have a capital gain of $420,000. But you only do that once.
That's Jack Mintz, by the way. He studied 10 years worth of StatsCan data from people who filed capital gains in Canada. What he found is that the majority of people only file once.
And in fact, that's what the data shows, is that 2/3 of people only have capital gains only once and or very infrequently during their lifetime.
So year over year, sure, you have, maybe tens of thousands of people filing these huge gains, which might make you think it's the top 1% of society, when in fact, a lot of it might just be a constantly revolving door of regular people cashing out their once-in-a-lifetime gains. Even a simple transfer of assets can count as a capital gain, even if no money changes hands.
And I said, why should I pay capital gain? I'm not selling it to them. I'm gifting it to them.
Farmers have lots of cash, but it's tied up in land, and the entire purpose behind farming is to pass it on to the next generation. So anything that makes that more complex, more difficult, and more expensive isn't good.
A lot of Canadians, I think, may have inherited those cottages. So maybe they weren't inherently wealthy to begin with.
These are the sorts of situations that Pierre Poilievre is staking his claim on, that Trudeau is taxing everybody to death.
And it's incredible. During a healthcare shortage, he wants to tax away our doctors. During a food price crisis, he wants to tax our farmers. He wants to tax our small business job creators.
So that was a lot. What is Poilievre talking about here? Well, small businesses. The idea there is that if an owner wants to sell their small business, like maybe they're retiring, they're winding things down, their nest egg just got a fair bit smaller. $1 million in after-tax profit under the old rules would shrink by about $100,000 under the new rules. If you care to see the math on that, we start with a capital gain, a profit of $1.36 million. And you'll see in a moment why I chose that number. Under the old regime, half of that was taxable, most likely at the highest tax bracket of 53%, assuming, once again, that you're in Ontario. Take that percentage away from half of your profit, and you're paying about $360,000 in taxes. This minus this is what you're left with, a cool $1 million even. But under the new regime, someone selling their small business for the same amount of profit pays tax on half of the first $250,000. That's the individual exemption. That works out to about $66,000 in tax at our current tax rate. And on the remaining $1.11 million, 66% is taxable. That's about $732,000 that we have to pay taxes on at our 53% tax rate. That means you're paying almost $390,000 in tax on this amount. You add these two numbers here, you end up with a grand total of tax, $456,000, which is almost $100,000 more than we used to pay for the exact same sale. Let's talk about doctors.
Anything that's making things harder for family physicians is really concerning to me because we know that over 6 million Canadians already don't have access to a primary care provider.
Many doctors don't collect salaries in quite the same way you and I might. Many of them incorporate, meaning in a legal and a financial sense, they become a company. Why incorporate? Well, it's a way of getting around high personal income taxes. So in Ontario, for example, instead of paying progressively more and more income tax the more money I make, all the way up to the 53% tax bracket, an incorporated doctor could pay the small business tax rate, which is way lower. In Ontario, it adds up to about 12% total on the first $500,000 in taxable income. Now, a doctor can't stay a corporation forever. At some point, they need to draw down that money for personal use. But for all those years, the tax money that they saved, they were probably reinvesting through the company, buying stocks and bonds, which then grow in a compounded way, all the way to retirement. That's how many doctors plan for retirement. But under the new rules, once they sell those company assets, they'll get hit with this new, higher capital gains tax.
For example, my corporation, it's just me. There's no shareholders, there's nobody else making money. And so me as an individual saving for retirement, saving for sick leave or maternity leave, I'm going to be facing an increase in my taxes as I try to save for those things because doctors don't have access to pension or sick days or maternity leave or parental leave.
Officially, the position of the Canadian Medical Association is this change to the capital gains tax will hurt healthcare in Canada, especially because incorporated professionals, which includes many doctors, they don't benefit from the exemption on the first $250,000 in capital gains that we individuals get. So when they retire and start selling assets from the corporation, they're paying the new 66% inclusion rate from dollar number one. Depending on which province they live in, that's effectively like having your tax rate go up 8 to 10%. This, Poilievre argues, makes being a doctor in Canada much less attractive. He reasons this tax change punishes all the wrong people.
Haven't the Liberals learned that taxing away doctors, taxing away home builders, taxing away the entrepreneurs who make paychecks is economic wackoness?
So, is Poilievre the one who's telling the truth?
Will it destroy jobs? That's a more difficult, nuanced question. So this is one more incentive to have people not start up business, not come here and to leave. But you're not going to have, I don't think you're going to have a wholesale departure of entrepreneurs.
It's going to definitely hit some of the very wealthiest people, no question about that. But there's going to be a lot of middle-class people that are going to be affected.
What makes this such a messy question is that Canada's tax code is complicated. The math, in reality, isn't always as clean as how I presented it to you. For example, there's what's called a lifetime capital gains exemption for certain asset sales. So the first $1 million a person makes from selling a business or a farm, for example, that's not taxable at all. 0% tax. And the Liberal government is increasing that exemption to $1.25 million. And honestly, there are just so many exceptions and eligibility requirements and qualifiers on just about every single aspect of the tax code. Way too many for us to go through here. Like, we had to run our own calculations through several accountants to be sure of the math. So bottom line, if you're just an average person, the likeliest way you'll be directly affected by any of this is if you own an investment property. Somewhere, you don't live personally, but you might sell or transfer at some point. On that, you stand to lose tens of thousands of dollars on that eventual sale. If you're selling a business, you stand to lose much more than that, but only if you're already making a fair bit of money, well over $1 million from that eventual sale. Either way, more of your money goes to the government for healthcare, for housing, for whatever their priorities may be. What does that money add up to? Well, from their estimates, nearly $20 billion over the next 5 years.